The Fed is about to break more than just the housing market. After coming out and raising the Fed funds rate 75 basis points this week and hinting at a potential slowdown, he then came out about an hour later and said this.
It is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go.
So even though the Fed changed their verbiage a little bit, which you can see here, where they say in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. They also go on to say the committee's assessments will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures and inflation expectations, and financial and international developments. So with all of that said, the Fed tends to get aggressive and remain aggressive. In fact, that's what happened after the Fed funds meeting. So at the end of the day, it looks like the Fed is going to remain aggressive. You know, in their original speech when they came out, the bond market actually improved because, you know, they hinted at actually slowing down, you know, the aggressive hikes that they're doing with the Fed funds rate. But then all of that changed and the bond market got worse after Fed Chair Powell came out and basically said that they're going to keep an aggressive stance. They're going to remain aggressive. Even though they're going to watch the lags in the market, their stance is going to be aggressive, which in turn likely means higher interest rates for the short term, unless they break something before then. Now, what am I actually talking about? Well, in their commentary, as I mentioned earlier, they said the committee's assessments will take into account a wide range of information. And in there, they talk about labor market conditions, inflation pressures and expectations, financial and international developments. Well, if we go to the last part of that sentence, financial and international developments, we know the Bank of England just did their highest rate hike in history. We know that parts of China are going through the zero COVID policy. At the same time, the war between Russia and Ukraine is still ongoing. So we definitely have some international developments. And now let's talk about labor market conditions. Even though jobless claims remain low, job creation is at its lowest level since December of 2020. And we actually saw the unemployment rate tick up to 3.7%. So we're starting to see some of these effects with regards to the workforce. At the same time, we're seeing companies like Stripe laying off 14% of its workforce, Twitter laying off half of its workforce, Lyft laying off 700 employees, and Amazon and Apple both pausing hiring for the short term. So while the Fed wants to remain aggressive, I feel like they only have a short period of time where they can actually continue to do that, because we're starting to see the effects come up in employment. And many of you guys out there have commented on my videos and said, wait until unemployment continues to rise. That's going to be the downfall in the market. Well, I'm not arguing the fact that unemployment is likely going to rise, and that's going to have an effect on the economy. But as long as the economy continues to give better than expected news, both on employment and inflation, the Fed has the green light to continue doing what they're doing, which is get aggressive with the Fed funds rate. We're already seeing first-time homebuyers being shut out the market. We're actually seeing the share of first-time homebuyers plummet as first-time homebuyers are being shut out of the market. And at the end of the day, you need these first-time homebuyers to come into the market. That's part of what helps housing continue to move forward. First-time homebuyers typically buy this entry-level housing, and then those that own the entry-level housing tend to sell that property to first-time homebuyers and move up to next-level housing, and so on and so forth. So without first-time homebuyers buying this entry-level housing, that puts further strain on the housing market. And even though mortgage rates have dipped back below 7%, we've seen mortgage applications decline because there's less and less people out there that can afford homes at these prices. So even with interest rates dipping back a little bit, home prices haven't dropped significantly enough in most markets to make housing any more affordable. On top of that, a lot of people out there are looking at the economy and seeing the possibility of a recession happening becoming more and more transparent. And so while I've been wrong with interest rates over the last year or so, with the idea that I didn't think the Fed would be this aggressive because I thought they would have to take their foot off the gas pedal sooner than later because of the effects on the economy. But the reality is what they're doing hasn't actually shown up in the data yet. Even though they've said the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, at the moment, that hasn't shown up, and it's not likely to show up for a couple of months. So while they're getting super aggressive month over month with rate hikes, they haven't actually paused enough to see how this is actually going to affect the economy. And in my opinion, by the time they get to the point where it's reflecting in the data, it's going to be too late. They've already gone too far, too fast. And while they say they're going to pause and keep interest rates high, I think by that time, unemployment has already started to rise and inflation has already started to come back down. Now, while inflation isn't likely going to hit their 2% target for some period of time, in fact, we'll likely be in a recession before we hit that 2% target. And with that said, we know recessions are deflationary. So a recession should help bring inflation down in and of itself, on top of less economic activity actually happening out there in the market because of everything that's going on. So many of you are looking at this going, Jeb, this is exactly what we've been talking about. This is what's going to cause the further down leg in housing. And in some markets, it might cause a further down leg in housing. If your market is primarily made up of entry-level homes where almost, the greater majority of buyers out there are first-time home buyers, that market is going to suffer more than markets that have money, that have other price points that buyers are interested in. The markets that are going to slow the most are the ones that are most affected by affordability. Now, at the end of the day, everyone is affected by affordability, but the one thing that will likely keep housing strong in many markets is the fact that many sellers out there have locked in a super low interest rate. And unless you have to sell your property, then regardless of what's happening in the market around you, you're going to be in good shape. Now, those that have to sell for some reason, maybe because of a loss of job or debt or potential divorce, yeah, those people are going to be affected just because there's less demand in the market. Affordability is still a problem, on top of a lot of people worried about the uncertainty of the future. But if you've bought for the right reasons, you have money in the bank, you're comfortable with your housing payment, and you have a longer term time horizon, there's really nothing to worry about because you have to have shelter. But with that said, I do believe the future of housing over the next couple of months, 4 to 6 months, is actually going to be slow. The numbers that are going to report out there with regards to pending home sales, existing home sales, are going to be really bleak. For one, they're going to be a lot lower just because there's less activity out there happening in the market. On top of that, they're going to be a lot lower because they're being compared year over year to numbers that aren't really normal, right? This time last year, the market was crazy. When traditionally speaking, this is a slower time of year. But when they compare this year's numbers to last year's numbers, it's not going to be good. And as long as interest rates continue to stay elevated, that's going to continue to put pressure on housing, on affordability, and ultimately house prices. And while I personally don't see a housing crash coming, I do expect the housing market to remain slow for the foreseeable future.